You know those action movies involving planes where the plane suddenly loses altitude, starts vibrating like crazy, cabin lights switch on and off, oxygen masks spring out. In the cockpit, lights are flashing, there's constant beeping everywhere, and pilots are pushing buttons, shouting random commands, and yanking the joystick up, trying to somehow stabilize the plane.
Lost hydraulic center. This is Southjet 227.
In much slower motion, this is happening right now with the RBI. For so long, convinced that GDP growth would average over 7% this year, that there would be no need of any policy support, RBI went into a jalwa hai hamara yahan mode. Interest rates were kept elevated. Banks and non-bank finance companies were penalized for making too many personal loans. And the RBI went so overboard in trying to artificially keep the rupee strong by selling dollars that the vacuuming out of rupees in the process left banks scrambling for cash for their daily needs. But then the narrative on growth changed. In the July to September quarter, GDP growth crashed to 5.6%. In the October to December quarter, despite festivals, despite wedding season, despite government spending more money on infrastructure projects, despite good rainfall and bumper crop production, despite all these boosters, growth could only pick up to 6.2%, with investment growth in fact further slumping. It goes on to show how delulu RBI was in tightening the economy for so long in a supreme confidence that growth will be 7.2% this year. But hey, don't shoot the messenger. Just open your Demat account and see how the cookie is crumbling. You can tell yourself that this is because foreign investors have been exiting India, but let's be honest, that's a polite way of saying that be it for domestic reasons or for foreign pressures, the economy isn't doing as great as people previously assumed it was. And by the way, those of you wondering, should I continue with my SIP or not? Well, the true bloodbath will happen when you, the domestic investor, starts to lose confidence. Yet, for the longest time, both RBI and the government have been like, relax, everything is fine. But now the fire alarm is ringing. The budget is a prime example. It's not for nothing that the government announced income tax cuts. It's because they too see consumption sputtering. Whether it will make a difference remains to be seen. As we had flagged in our past video, the income tax cuts target a small slice of the population and is getting financed by economizing on public spending, both on infrastructure and on regular programs. And now the RBI is finally waking up too. Since the new year, the new governor has quickly unwound Shaktikanta Das's tight policies. And the reason why a lot of the general public may be oblivious of this epic U-turn is because monetary policy doesn't have the PR that fiscal policy has. I mean, it's more common for people to get passionate about, say, income taxes or Ladli Behna type freebies than news on RBI, which is usually jam-packed with words like variable rate repo, open market operations, durable liquidity, buy-sell swap. And so people naturally tend to zone out, without realizing that the drama in the bond market also affects them as much as a politician announcing freebies somewhere. But hey, if you are viewing this channel, this is something that you shouldn't have to worry about. Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Arudeep Nandi. And today we discuss how the RBI has gone from taking growth for granted to actively rushing to revive growth. What exactly is the RBI doing? How do those measures work? And what will be the impact? As always, if you like what you see, please hit like and subscribe. And if you'd like to support me, feel free to use the QR code on the screen or the super thanks button below. First things first, how is it exactly that the RBI can influence growth? Well, the RBI has three levers at its disposal. First, the actual policy interest rates, the fundamental peg to which all interest rates in the economy are linked. The RBI governor, along with 5 other members, so 3 from the RBI, including the governor, and 3 external experts, vote once every 2 months to decide whether to hike, cut, or keep the policy rate where it is. 2, RBI is like the godfather of banks and other finance companies. It takes one boring press release on RBI's website to screw up their happiness for months at a go or make their lives incredibly easy. This in turn impacts their ability to extend credit to the rest of the economy, and consequently that impacts growth. And 3, and very importantly, the RBI lords over liquidity, the amount of excess money that is floating around for banks to borrow and lend amongst each other so as to run the economy. Much like the grease in the cogs of the economy, too less grease and immense friction is generated, growth slows and the machine breaks down. Too much grease and the cogs slip, the machine runs too fast, inflation starts rising, and the machine eventually again breaks down. Now, like the desperate pilots in those plane crash movies, at this point, the RBI is tugging hard at all these 3 levers. In February this year, the Monetary Policy Committee voted unanimously to finally change course and do the thing that previous Governor Shaktikanta Das was dragging his feet on, namely cutting the policy repo rate by its first installment of 0.25%. So since mid-2022, higher inflation had led the RBI to hike the policy rate from 4% to 6.5% by early 2023. And since then, the RBI has kept it elevated, refusing to bring it down, even as underlying inflation was coming down. And we've been arguing about this passionately on this channel. In short, inflation being high because, say, vegetable prices are rising is very different to inflation being high because growth is too strong and the economy is overheating. The latter calls for higher interest rates to cool down the economy and in the process bring down inflation. But if you're trying to douse higher food prices with higher interest rates, well, all I can say is that's not how that fire extinguisher works. But the RBI refused to budge until now. And generally, when a central bank starts cutting, it tends to deliver a few rate cuts in quick succession to quickly get interest rate down to where it needs to be. So this is lever number 1, bringing down interest rates. Lever number 2 is for the godfather to make life easier for banks. So back in 2023, RBI started getting really worried that banks and other finance companies were over-lending to households. In fact, I had started this channel around that time. One of my early videos was around why the RBI is afraid of your credit card. So essentially, RBI has regulations in place such that if you as a bank need to make out X amount of loans, then you need to keep at least some percent of that X, that loan amount, in your bank as capital, as your reserves. That is the money that you as the bank will have to raise. So let's say the RBI has a 9% minimum capital requirement. Then for every 100 rupees lent out, the bank needs to have 9 rupees as capital. So intuitively, you can see for yourself that if this ratio is increased, then the bank has to allocate more capital to make the same 100 rupees loan, of course, making it more expensive for banks. Now, here's RBI's problem. Suppose of this 100 rupees that a bank is lending out, let's say 50 rupees is given for home loans, against which there is an actual collateral, namely the home. And the other 50 rupees is going out as a personal loan, against which there is no collateral or what is known as unsecured loans. Or maybe the bank is loaning out that 50 rupees to a non-bank finance company or a fintech firm that is in turn giving out personal loans. So RBI is like, hey, we can't treat both these 50 rupee loans the same way. The home loan of 50 rupees is much safer than the other 50 rupees of personal loan. In fact, the person who is borrowing that personal loan may already be sitting on 5 other personal loans that he is struggling to pay back. So how do I discourage the bank to make such kind of loans? So central banks have a very clever thing called risk weights. It says that, okay, when you calculate the capital that you need to park aside for making these loans, it won't be as simple as, oh, you've given out 100 rupees of loans, so 9% of 100 is 9 rupees. Nope. Instead, For the 50 rupees going for home loan, we will treat it as 50 rupees. But the other 50 rupees of personal loans, we are going to add, let's say, 25% more to the loan amount to calculate the capital that you need to keep aside. So that 50 rupees will be treated as 50 rupees plus 25% more, which is 62.5 rupees. So now the loan book looks like 50 rupees home loan plus 62.5 rupees personal loan. So the total size of your loan book is around 112 rupees. So earlier you had to keep 9% of 100 or 9 rupees as capital. Now you have to keep 9% of 112 rupees, which comes to a little over 10 rupees. So the bank has to cough up more than 1 rupee of extra capital in this little example, just because it wants to give out personal loans. So if you were a bank, what would you do in this situation? You will obviously prefer lending more to sectors that the RBI wants you to lend to, and less to NBFCs and less towards personal and credit card loans. Because yes, you can charge higher interest on a credit card loan, but Godfather is also asking you to keep more capital aside for making that loan. So the cost has also been increased for you. And that's exactly what happened since end 2023. Banks got so penalized that the growth of bank loans for credit cards and microfinance customers and to NBFCs that were in turn making these kinds of loans crashed. At the same time, people who had taken out too many personal loans and were literally taking one loan to fund another loan have now been defaulting left, right and center. So now the new RBI governor is essentially saying, enough, ye bahut zyada ho gaya. So from now on, the RBI will reduce the risk weights on these loans. And so banks now, for the same capital, you have the freedom to make more such loans. So I hope you're getting the drift now. The RBI is easing interest rates. It's making it easier to give credit. But levers 1 and 2 won't achieve much if the liquidity in the system is tight, which brings us to the all-important third lever, loosening the grip on liquidity. What's liquidity all about? Well, banks take money from you as deposits and lend to others as credit. But the RBI comes in the middle and says, hey, banks, wait a minute. You need to park a fraction of your deposits with me compulsorily. It's also called the cash reserve ratio, CRR. But here's the thing. People are making deposits and withdrawing money all the time. So at any point in time, Bank A might be sitting on excess money. Maybe it got some big deposits that day. But simultaneously, Bank B may be facing large withdrawals or has to lend out money. And so at the end of the day, is desperate for funds to meet its reserve obligations. So what do banks A and B do then? Well, they go to the RBI. Bank A with excess money parks its money with the RBI for a day. Bank B, which needs money, borrows from the RBI for a day. But RBI is like, guys, why do you need me in all of this? Just lend to each other. To make this happen, the RBI says, okay, anyone who wants to park their excess funds with me, I will pay you 0.25% lower than the repo rate. And it tells banks that need to borrow, sure, I will lend to you, but be prepared to pay 0.25% higher than the policy rate. Or you can borrow and lend between each other. So that interest rate between banks, also known as call money rate, will obviously be within this corridor of plus minus 0.25% around the RBI's policy rate. Because if the rate was too high, banks would just borrow from the RBI instead. And if it was too low, the bank would make more money by parking it with the RBI. So, if I use my specs, imagine the policy repo rate in the middle. And so the RBI has created a plus minus 0.25% band around it. And so the interest rate that banks charge each other basically vibrates between these two bounds, ideally close to the policy rate. Despite this, every day, some banks still have to knock on RBI's doors for funding because they couldn't raise enough funds in the market. And so a measure of how loose or tight liquidity is in the market is determined by the extent to which banks on a net basis are forced to borrow from the RBI every day. If this number is positive, it means the RBI is injecting liquidity on a net basis, which means liquidity is tight. So intuitively, hopefully you can visualize banking system liquidity as the surplus or the shortage of money in the banking system that eventually gets reflected in what banks are parking or borrowing from the RBI every day. And this in turn impacts short-term interest rates as everything is connected. The overall interest rates in the economy ultimately is linked to the interest rate which banks are using to lend and borrow to each other. So when the RBI is worried about inflation, it makes sense for it to keep liquidity tight. And when it's worried about growth, then it makes sense to keep liquidity easy. So what influences liquidity? Well, sometimes it's just the usual ebb and flow of the economy. For instance, when the government spends money every month, that money enters the banking system. When GST payments are done, it exits. That's natural. Then there are durable drivers of liquidity, which are not all that temporary. Take, for example, the festive season. People tend to withdraw a lot of cash from ATMs, which is technically known as currency in circulation. More people withdraw from the ATM, lesser money is available for banks to lend to one another. And so liquidity durably tightens. It will be some time before that money makes it back to banks. The other major driver is RBI's exchange rate intervention. If the RBI sells dollars, then it buys rupees. That drains out domestic money markets and gets banks to fight amongst each other for liquidity, which means that interest rates pick up. A mix of both happened during end 2024. The festive and wedding season led to massive cash withdrawals. And very critically, RBI's aggressive attempts to stop the rupee from depreciating, which for some reason was a priority for ex-governor Shaktikanta Das, left banks starved of liquidity. You can see in this chart of durable liquidity how it nosedived from a surplus of almost 5 trillion rupees in October to deficit below zero at the start of 2025. See, I wasn't joking when I was comparing this to a plane crash situation. India found itself in a full-blown liquidity crisis, arguably of its own making, and not a crisis it could afford when growth is weak. So how has the RBI changed its course? One-line answer: by injecting liquidity. But what does that even mean? Well, it's kind of how money gets created. See, at the epicenter of it all is something known as high-powered money or reserve money. This includes two key components: currency in circulation and bank reserves. Not just what's mandated by the RBI, but also what banks like to keep over and above the minimum. In the RBI's balance sheet, these are its liabilities. This is what it owes. How does the asset side of its balance sheet look? Well, the two obvious entries are government bonds that the RBI owns and its foreign exchange reserves. There is a bunch of other stuff on the balance sheet, but let's ignore them for now. So how does the RBI create money? Well, simply by expanding its balance sheet. It can do this by increasing its asset side, so buying government bonds or by buying dollars, because in exchange, rupees is going to banks on the liability side. Banks in turn lend this money to others, which then forms deposits that lead to further lending. This creates a multiplier effect. Now, here's where the RBI has slipped. Over the past year, it has been really sluggish in expanding reserve money, which is an important reason why there hasn't been much deposit creation going on. You know, people keep saying that it's because people are preferring mutual funds to fixed deposits, but the fundamental reason is often overlooked. RBI just isn't creating enough high-powered money, enough reserve money. You can see how lethargic reserve money growth has been. In fact, the reverse was happening. By selling dollars to stabilize the currency, RBI was shrinking its balance sheet and hence reducing the reserve money in the system. Now, the RBI is desperately trying to correct this. It is buying more bonds, it's purchasing more dollars, and pumping more liquidity into the system. In December, it cut the cash reserve ratio for banks. So remember, this is what they are mandatorily forced to park with the RBI. So if this is cut, this frees up more money for banks to lend and play around with. In January, RBI announced large-scale bond purchases, also known as open market operations or OMOs. Again, you purchase bonds, so you are injecting money into the system. It also lent out money to banks for a longer period than just one day. And finally, the RBI is undertaking dollar rupee buy sell swaps. This means buying dollars today and hence injecting liquidity, and then agreeing to sell them a few months or years later at a certain rate. So overall forex reserves eventually remain unchanged, but very importantly for now, liquidity gets injected into the system. Overall, it is estimated that the RBI has injected around 3.6 trillion rupees of durable liquidity. To give you a sense of how massive this is, you can see in this chart which we showed earlier of durable liquidity, how 3.6 trillion rupees of liquidity infusion is close to how much the liquidity surplus was back in August 2024. But despite all of this, a lot of market participants will tell you that when you do the math of what is going to come in and going to go out of money markets, more liquidity support is needed. And look, despite the RBI cutting the policy interest rate, bond yields are floating higher. It's like those planes in the movies. It's not enough that a pilot simply correct the joystick and the plane immediately stabilizes. It takes time for the measures to kick in, to change the trajectory, to ease the financial sector pressures, and then for growth to stabilize and then recover. The hope is that the plane doesn't crash before it stabilizes. For more such insights, like, share, and subscribe to The Bond Economist.